Apparently, we are live. Good evening, everyone. My name is Simon Misiewicz, and
my name is not Simon Misiewicz, it's Louise Misiewicz. Good evening.
And what are we talking about, Louise? This is your event. I'm just here for the technology tonight. So what are we going to be talking about?
Are you my assistant for the evening?
I am your assistant with a skirt.
It's not a skirt, I can tell you now.
Oh.
It's a pair of jeans, and funny enough, with a tomato ketchup stain on, but we won't go there. Tonight, we are talking about self-assessment tax returns, the thing that has been on the tip of your tongue for weeks, months, years, I'm sure, and that you'll be very excited to talk about. Probably not, but it is that time of year. We are just a matter of, and I hate to say this, we are just a matter of a few weeks away from tax filing. If you look at the 31st of October deadline, and just a few weeks beyond that, if you're filing by the 31st of January. So hopefully tonight's session will be to help you to perhaps bust some myths, to explain some queries or questions that you might have, and to start to help you navigate and pick up that tax return and get on with it. Because I would say the biggest worry and the biggest pain is the fear of picking it up rather than getting on with it. But that's just my view.
Is that because it's heavy?
The jokes definitely need to tone down. He's already been attempting to trial some on me before this session, and I shall apologise now in advance because they are horrific.
Just out of interest, I'm just going to go to my studio, so I'm just looking at the tech to make sure everything is working. But if you do have any questions at all, we are live.
We are live.
And therefore, Louise will be taking those questions. I will be doing nothing more than reading those questions out to everyone. And in fact, one thing I have just noticed, don't want to be doing that one. Let me just come out of that. Is I need to be putting on us on podcasts. So let me just do that
live
as
on
well.
Podcast for the first time.
Yeah. So here we are. So hopefully we are recording this now live on the podcast as well. So we're on Clubhouse. This is the first time we've used it, so it might be a total mistake because I'm not sure if it's going through my microphone, which is interesting. It's not going up and down. But anyway, if you are live, just say hello to me. That'd be great. I can see a couple of people now joining us. So if you have any questions, feel free to fire those.
Gimme. I like questions. Questions about self-assessment filing. Boo hiss. I know. It's such a joyful topic, but I genuinely like it because I want to help you get over your fear, or get over a period where you kind of keep looking at it and putting it down and not getting on with it. So my aim tonight is to get you over that hurdle of fear and into the final straight. You can tell I never did sport as a child. Sorry, my analogies are dreadful. But I want you to crack on with them, and I want you to not be worried. And anything I can do to help you do that tonight is what I'm here to do.
So you'll notice I'm looking down most of the time, and that's because I am looking at different social media streams. We are on Clubhouse. We have our first person as well, Richard.
Hello, Richard.
Good evening, Richard. He can't see you because this is a podcast.
I know.
I'm so sorry, YouTubers, for that. Louise is looking at you, and she's talking to
well,
Richard.
I'm not exactly going to look up in the sky, am I, or look down to the floor. So I'm going to talk to the people that are there.
Talk to the people of the people land.
Oh dear.
Right. So let's. Shall we make a start with the
then.
type of questions that we might be fielding out?
I would like to.
Okay. So this is from Jubilee Property Investment Limited.
Hello,
that
Jubilee.
Is actually that is their name on YouTube. So hello there.
Hello.
The question was set around about my accountant in regards to refurbishment costs. We bought a property through a limited company. Now we are going to be talking, if you can hold that piece of paper up for everyone on Clubhouse listening in.
I'm so sorry, team. If you can't see this is property page 1 of a tax return, personal tax return, property page 2 of a tax return. And my life tonight is most likely going to revolve around these, but I'm guessing that Jubilee Property has possibly a very helpful question that, quite frankly, it doesn't matter what tax return is going on. You just need to understand the principles.
Well, I think the audience really wants to know what that question is.
Go for it.
Right, brilliant. So it is about limited company, but we'll ignore that because the principles works for self-assessment as well as limited company.
Yes.
Right. So with that in mind, what they've said is that they haven't had a refurbishment, which it had a revenue cost, which he believed, of renewed and replacement items. The accountant is, however, saying that 18k is capital, as we did not have any rental income first before the refurbishment takes place. So I'm going to let you, because it's your show, Louise, so take it away.
Take it away. Okay, I'm not going to do this in the method of mime. You'll be very pleased to hear, everybody. I'm actually going to do my best to answer. So let me just recap over the question. The question was, I have a property, doesn't matter whether it's in your personal name or limited company for the purposes of answering this question. I have a property, it's a rental property. I have bought it, I have refurbished it, I've done work to it, and I'm being told by my current accountant that maybe all or some of that work is not tax deductible because it's classified as a capital expense, not a revenue expense. That's a really, really interesting question. Excuse me. I would say that there's probably an element of truth to what your accountant is saying and an element of perhaps misunderstanding. And what I mean by that is that just because you are refurbishing it for you to use in your business, whether that be in your personal name or limited company or even partnership, just because you're refurbishing it to a standard that is akin or aligned to the rest of how you run your other property business activities, doesn't necessarily force it to be capital. There are typically a couple of occasions when an item is capital and not revenue, and therefore won't help minimize your personal tax position. The first example is typically when you are completing a piece of enhancement to the property. So you are building a bedroom in the loft for the first time. You're extending the property and adding on extra rooms to the property that were not there before. Those are enhancement in nature and will therefore be capital. And the only time typically that you'll be in a position on a residential property to claim the expenses to help minimize your tax is at the point of sale, when you'll use them to help minimize your capital gains tax. The second example of when you might hit capital expenses is if you take on a property that, quite frankly, is not livable in. It is so distressed, you've got to do work to it in order for it to be of a lettable standard, even a basic lettable standard. And such expenses to deal with such distressed natures of property, unfortunately, are capital in nature. So again, it may be, to your eyes and my eyes, a repair. So you're repairing perhaps a roof that's already there. You're repairing a kitchen that's already there. If it is literally unlivable, then I'm afraid it is going to be of a capital nature. Pretty much almost every other expense you might incur on having a property brought to a standard you wish to rent it to is going to be revenue. And I'm going to ask you to write this down now. I want you to write down the word PIM, P for Papa, I for Igloo, M for Mother, 2068. Now, this is a property income manual within Hmrc's rules, and it lists out for you beautifully about 20 or so different types of expenses that will help you understand what is revenue expense. Get that pen ready again, because I've got another one for you. PIM 2030. Now, PIM 2030 is again a lovely help sheet from Hmrc that brings to life when an item is capital and not revenue. So, Jubilee, I think you might want to share PIM 2030 with your current accountant to discuss and debate which elements of your cost are indeed capital and which elements of your cost are revenue. So I'm hopeful that might help.
Could you show, because this is about tax returns, we need to be really focused tonight on where that is on your tax return. So if you could show everyone, that'd be fantastic.
Okay, so I'm going to look at the residential property page. So this is page 2, and I'm so sorry if you can't see this. Can you see at the bottom?
Yeah, we could just see that.
It says UKP2. So this is the page on which you put your residential property
Just for
incomes.
clarity, what page is that? What box number, sorry?
Well, I'm going to talk about boxes in a second because there's a lot of boxes on this page.
Because we're accountants, we love boxes.
We do. But typically, a repair, replace, renew expense falls in this property expenses box, box 25. It's where I'm kind of showing, I'm going to move my other hand down. It's where I'm showing my finger here. And it's here that you would capture the expenses to do with repair, replace and renew. And those three words are words that you probably are very familiar with if you're already a client of ours, or perhaps you've watched some of Simon's other videos. That is the box of delight. That is where you capture your revenue expenses to help minimize your profits, to help mitigate your tax.
Now, just answer and aside from that, there's one more question I want to answer you from a tax return perspective. But anyone listening from a property tax perspective, one and the same, but I always have to say that there's a differentiation from tax advice and tax returns, and that is theoretical of the property tax. And what I mean by that is when we think about buy-to-let mortgages, one of the conditions for you to get a buy-to-let mortgage is that it's in a lettable condition. And if you look at that very page that I've put a link, because Louise mentioned the link, so I've put that on the chat box. But if you look at that manual, it will say quite clearly that you can have a revenue expense if the property is in a lettable condition. Well, if you've got a property with a buy-to-let mortgage that also is in a lettable condition, there's no room for any accountant to say, well, I'm going to dismiss this as capital. It just doesn't make sense.
There is a final thing that I'm just going to mention, if I may.
No, because you're going to really steal my thunder. You need to wait. I'm sorry. It's your show. It is your show. But really,
You heard it here, folks.
there is one question I have. So in terms of people that have a self-assessment tax return, and again, if you could just hold that up for a second, because people that might use these sheets, I'm just going to get it ready for Louise to see the screen itself. But people using these boxes, the one thing I would say is make sure that you have a receipt. Now, if you have, and we talked about this earlier, if you have a receipt from a builder that says refurbishment costs £30,000 with no description at all, tell us some best practice about what the invoice should look like and the details contained within that invoice.
Well, firstly, there should be an invoice, or there should be some form of receipt to validate that you genuinely have had that expense. And sorry, guys, you probably half already know this, but you've got to hold on to those receipts. And I would argue, hold on to them for about 7 years after the tax year in which they actually fall due, because Hmrc could ask you for them. And if you don't have them and they open an inquiry, you will be in a really bad spot in terms of being able to explain how you've arrived at your expenses. But if you do have an expense and you have, as I say, a receipt, don't allow the supplier to control what is said, or rather what is not said on the receipt. So you want that receipt as much as you can get itemized, particularly if there's an element of capital and an element of revenue expense on there. You must have those two segregated so that you can see what bits are revenue, what bits are capital. And an invoice should have a small number of things on it. So without boring you to death, the first thing it should have on it is, of course, your details. So which property were they working on, maybe even which room, if it's divided up into, for example, a HMO set of rooms or mini flats. You need to have the date as to when the invoice was released. You need to have it actually say it is an invoice. You need to be able to see the expense, both in terms of if it's VAT, you need the VAT on there as well. You need the VAT registration number of the supplier. You need the name of the supplier on there. So just as a small number of key points, you really need those points on. I have seen, and it happened to a client of mine not so long ago, that they incurred an invoice for approximately, I think it was £20,000 for an improvement to their property. It was broadly described as, and it was pretty much, it said on it, fix new kitchen. What it should have said was remove old kitchen, install replacement kitchen. And because it didn't have those words, the Hmrc agent who actually oversaw the investigation, because it was as an investigation that this came up, decided that they would not allow the expense as a revenue expense. And so the only thing that their client could do, if they couldn't get hold of the builder and get the builder to reissue a corrected invoice, was to hold that invoice for capital expense. Well, that individual at the time was incurring 40% tax, which meant that a £20,000 expense had just added approximately £8,000 worth of tax to their personal tax return, just because the invoice didn't say what it should. And that's something I wouldn't want any of you guys to fall into the trap of. And there may be invoices already that you're at a stage now. Sadly, you're not going to get them corrected. Maybe the builder or whomever it was that supplied has gone out of business, or you're no longer in contact with them. But for future, please be very much in control of what those receipts say. And if you're not happy with what the invoice or receipt explains or describes, discuss it with the supplier and get it corrected.
I think the other side of that is, if you are using a bank account, which I think you should do, is make sure that it is going out of your property bank account, so you can match the expense out of the bank account itself with the invoice, with the item, either in Xero, QuickBooks, or some other bookkeeping system, that you can tie all three together. Because if you can get to a stage whereby, sorry, Louise, but if you have a stage whereby you have a tax return, and then behind that you have an Excel report or a Xero report or QuickBooks report that marries each of these numbers, and then invoices behind that. To be fair, that's a bit boring sound like, because it's an auditor's role to do that, but it would be so solid as a tax return because no one could raise any questions. So if you want to be robust and strong about what you're doing, make sure that the receipt is descriptive, that it does use the words repair, replace, renew, as opposed to, as Louise said, new. You don't want new, you want renew, and
Replace.
then replace, renew,
replaster, repaint. There's a lot of re's here, and that's what you want if you want to get it under revenue.
And to be honest, this is a sermon. This is a religious education, as well as a tax. I did tell you his jokes are bad tonight. Sermon. So
mind you, they're bad all the time. Anyway, moving on. One last thing before he so interrupted me. What I did want to say to you is that sometimes people get a little bit concerned or confused over, well, I am replacing something, but actually it's an enhancement. You told me, Louise, enhancements are capital in nature. Well, I'm replacing a single glazed window with a double glazed window. I'm replacing lead pipework with latest plastic pipework. Technically speaking, it would be pretty impossible to correct and replace something with the same item as prior if the laws around minimum standards have changed, or indeed standard practices change. So standard practice these days is that it's double glazed windows. Standard practice is that it's plastic UPVC push fit pipes. You can tell I'm no plumber. These things therefore mean that although they technically arguably could be an enhancement, they're actually not, they're a replacement, and you're allowed to have them under replacement and therefore revenue, not capital enhancement. So that was my final comment.
That's good. That's really good. So let's move on to a different question there, because I think we've
done that one to death.
I think we've done that really well, to be fair. Blowing on trumpet there. So we've got Kitty 2020. Hello Kitty 2020. She has asked on one of our videos previously, and we thought, well, let's just answering that in this. Can I deduce the agent fee from the Cheshire rental income? And here's an interesting thing, because if you have rental income of, let's say, gross £500, when you get that back from an agent, let's say that they've had some letting agents, so you have a letting agent fee, let's say it's 10%, so what did I say?
Cheap.
£500. So £500, let's do it 1,000 because it's easier. So £1,000 property, gross rental income. 10% of the is letting agency fees.
£100, that's gone.
So there's 900, but they did repairs of 200.
£300 gone. So
you only get £700 quid. So sorry, £700. Correction. But how should you account for that? Because again, if you look at the tax return here, and we're just going to, if you can hold that up for me, because I want to just go into the meeting room. If you have a letting agency fee, just describe where and how the £1,000 must go with the £100 and the £200. Where would that be shown in the tax return?
I just want to clarify, because I think Kitty's question, rather than it was where do I deduce, I think it's where do I deduct, or how do I deduct?
Yes, but this is certainly, albeit it's your show. Don't get ahead of yourself. This is.
I'm going to have a different assistant next time too. That's all I'm saying. So, cost of services is box 28. I'm just going to kind of point it out here if I may. So, cost of services, box 28. Is where you would put the expenses to do with, for example, letting agents, cleaners, gardeners, kind of labour that you might employ, even perhaps you've got an employee who does this work for you, you put it there. But the important thing to bear in mind is that line 20, or rather box 20, which is this one right at the top here. Box 20 is where you capture your gross rental income. So in the example that Simon gave, where it was a gross rent of £1,000, but you as the landlord actually only ever saw £700 hit your bank account because of the deductions, you'd actually capture that £1,000 here. And then you'd capture maybe £200 of repairs down here in box 25, which we've talked about already. And then over here in cost of services is where you capture the £100 worth of letting agent fee.
Can I just ask you a quick question? Because if I look at box 25, this is property repairs and maintenance. So that's the builder's cost.
So that's the £200 of expenses you've incurred on the plumbing problem that the letting agent had to correct. And over here is the £100 of letting agent fee. That's where that would go.
So you do have to break it down. And then in Xero or QuickBooks or whatever system you have, when you get the money in to reconcile, it will show as £700 coming into your bank account, and you're tempted to put that as rental income. I would always break it down, because if you get an inquiry, Hmrc will say, how much rental income do you generate from this property? You say £1,000, and then they say, well, you're only showing 700. You've just opened yourself up to a nasty inquiry on every month, on every property that you have, and they want now you to break it down. So I would always break it down in Xero QuickBooks. That marries up with the actual transactions from the letting agent. So getting a statement from them would be a good thing, because that will show you the money that's been remitted with the paperwork. Would you agree with that?
Most letting agents will automatically either post one to you or email one to you once a month. And if they aren't doing that, then you can demand that of them in the nicest of ways.
This is a live session, so if you're watching this on Clubhouse, which no one is watching us on listening into
it's
Clubhouse.
because of your bad jokes.
You did actually leave, Richard, when I gave the second joke out, but I think that was after you said your joke. So swings and roundabouts. But coming on to this, if it is a live session, so if you do have any questions, then please feel free to type those questions in, and we'll make sure we answer them. And a couple of questions have come in, so I'm just going to field those now.
Go for it.
So we've got Andy. Hi, Andy, on YouTube.
Hello,
Live. Now, Andy, I'm going to have to move you on to next week's show, because Andy's asked a question. I have a limited company with 2 buy-to-lets, and the lender didn't allow non-borrowers to have shares. Therefore, I couldn't set up gross shares for my 3-year-old daughter. Do you have any advice? We really want to focus on property tax returns this week. Next week is where we do property tax and business tax stuff as well. And I appreciate we could dive into the answer, but where we want to really focus on good content for tax returns. So please do come back for this next week, or indeed watch a future video, because I'll try and post that same question there, and then maybe host a video for that, just that one question.
Yes, absolutely.
So I do apologise, Andy, for palming you off.
We'll come to you.
But we will, I promise you. Just want to get this first show to do tax returns. So Suntox asks the question, do you need to declare income, salary, to Hmrc if your employer is based abroad and the salary is taxed at source even though you're in the UK? How do you not have the indefinite leave to remain? Oh, I think that covers.
Oh my gosh, that is an
tax.
awesome question. First off, it's almost like an exam question for the ADIT exams, which is the international tax. I won't probably be able to answer this in full at all, and I do apologise for that. But sometimes, most of the time, being taxed on income that is not UK based depends upon 2 matters. It depends upon whether you are classified as UK resident at the time, and there are certain rules around what tax residency looks like. It isn't necessarily about indefinite leave to remain. It's about, have you spent the right number of nights in the UK in a certain period of time to be classified as tax resident. And sometimes it's connected to your domicile. In other words, where do you see yourself living long term? Where are you living long term? And again, there's a set of flowchart rules you have to work your way through to work out whether you are domiciled and resident. More often than not, if you are domiciled and resident in the UK, most of the time, your worldwide income has to appear, not just on the property page, but it has to appear in a UK tax return. If you are resident but not domiciled, then there is a potential you may not have to show income outside of the UK, earned outside of the UK, and not brought to the UK on a tax return, which is a great outcome. There is a very, very specific time limit, though, as to how long you can keep claiming it that way. Just as a final flip, and I know this is not your situation, but just in case it is someone else that's listening in, if the other way around, you are domiciled in the UK, but you're not resident in the UK, the only income you need to show in a UK tax return is typically income generated in the UK. So I've probably rushed through that at a million miles an hour, and I'm so sorry I'm not able to answer it in full, but I think that probably needs a lot more work to be done to it to get under the skin of it for you.
What I've done is there's something called an RDR3, which covers residency tax. Back to Louise's point, I think that could be quite a strict one on self-assessment tax return, because if you are resident in the UK, you're conducting work in the UK and you're required contractually to do that, then that would point straight away that you have to declare the income in the UK. But your employer, to be honest, even though they are abroad, they should be setting up a payroll system within the country that they're working in as well. So it really does depend on, are you in the UK for work reasons, or are you just there for lifestyle reasons? And that really is quite tricky, because the company has to then work with Hmrc to say, well, how do we treat this person for tax purposes?
Well, not only have you got the employer's discussions with Hmrc, you've got your, as Simon and I've just described, you've got your domicile and residence layer on top of that. And then on top of that, you've also got something called double taxation treaties, which will determine the country work that you are employed by, so to speak, and the UK. What do they say about how and who gets the income captured in a tax return? Because that could trump everything else as well. So it's quite complex. I would definitely want you to talk to your employer about it in more detail and get them to give you the guidance so that you're doing the right thing.
You're not talking about Donald Trump?
No.
No. Okay, moving on. So the other question that's come through, which is, thanks ever so much for that question, Santa.
Yeah,
that's a very challenging question. And it's a great one to have on this type of show, because I think even if we're building above awareness of residency and so on, it gives you a flavour of where you can go. So hopefully you've got my link there, Suntalk, so for you to have a look at that and then see if it works for you.
Any more?
Well, yes. So Peter's asked a question.
Hello,
Peter.
Peter.
With the IR35 crackdown. By the way, crackdown, it's people talk about IR35, and so it's new. IR35 has been since the early 2000s.
I think the issue with it is there's been a resurgence of interest, stroke tax investigation, call it what you like, from Hmrc on IR35 matters.
Yeah.
To your point, let me just read that.
Let's get onto the question, because I think it says here, as a contractor, my employer will only pay me CIS in my own name rather than limited company. Where am I meant to put my rents now? And that's Peter, forgive me for when I'm saying this, but I think there's two streams of income. If you can clarify that for me, that'd be great. But let's just focus on CIS. So previously, what would happen, and I've done CIS quite a lot historically, whereby you have a principal contractor, then a subcontractor, and the principal contractor would pay £100 to the contractor less 20%, which is the 20% income tax, and you would get your certificates. And what you would then do is complete your self-assessment tax return. Most contractors would actually get a tax rebate. So that's when contractors should be doing their tax returns way before now, so that they can get the amounts. Now, what's happened, I suspect, is that people have been saying, well, I'll invoice you through my limited company to avoid CIS certificates and tax deductions, and then say, pay me gross. So I think that was really going against the grain anywhere from totally honest with you, Peter. So it might be just worth double checking with your accountant what the arrangement is, and with the principal contractor, and again, your relationship with that principal contractor. But nevertheless, IR35, what does that mean for principal contractors? Well, CIS deduction still hasn't gone. And IR35 for me only affects people that are trying to use a limited company as a service provider, like a consultant, NHS workers or management consultants, IT contractors. But contractors in this sense, construction contractors should be using CIS in a way whereby 20% tax is deducted from their weekly or monthly pay. I don't think that's really changed. And I'll talk about this a long time ago when I did it. But you should be paying tax also anyway. So I think it's a moot point.
I would say it's probably jumping slightly higher up, Peter, for a second.
You know, but do clarify.
If your contract with your main contractor, so your employer, for want of a better description, or main business provider, is a contract written up between your limited company and them, whether they are a limited company or an individual, then contractually the relationship is with your limited company, and they should be invoicing. Sorry, you should be invoicing and expecting to be paid directly into the limited company. But I'm very mindful that's now drifting out of tax questions and more into the legality of a situation, which I'm not a solicitor. But that's where my thoughts go. I kind of jump above the tax first and go, well, hang on a minute, what was agreed between the parties? And is one party now reneging on that? And how do we get that resolved first before you then jump into the tax point? I
do think that GAR would override that, especially for construction when CIS has been set up to do exactly that. So IR35 doesn't really try to avoid, doesn't really tackle construction because construction industry has already been dealt with. But I do think you need to have a look at that into some arrangement and see, especially if you have multiple employees of your own and then you're doing different types of work, then there could be an argument. But if you're an individual working for a principal contractor, I think that's pretty strict.
Sorry, we're kind of half guessing here, Peter, so please do share a bit more. That'd be lovely.
I might not be guessing, but Louise, you've heard it first that she just admitted on air to be guessing. That's shocking. That's shocking. Okay, so let's just go to a couple more questions that came through live.
Lovely.
I'm just trying to find it. Azal has said, can you use a deed of assignment for assignment of rental income to your partner who is not on the title deeds?
Ooh.
So, okay, so does this really talk about tax returns and so on like that? Do we let this one slip?
All I'm going to say is we covered deeds of trust on our recording on the 16th.
Can I just jump in? Peter has come in. Peter's rushed in and given clarity here. So possibly, if this clarifies, I'm a civil engineer rather than trades. I'm paid essentially for knowledge. So this is where IR35 could hit you.
Yes.
So this is certainly, it depends. Now, to get around IR35 as a professional service provider, the best way to do it is if you've got 6 or more customers. Now, when I say 6 or more customers, I don't mean one big customer that gives you 90% of your income and then 5 small diddly customers that gives you 10%. That doesn't work. You need a customer base and your income needs to be spread across all those particular customers. And my feeling on that is that IR35 cannot affect you because you have now justified yourself as a professional company providing services, not providing a service. And that's where IR35 came in, actually, funny enough. It was, are you providing a service or services?
Are you a glorified employee?
Yeah, that's right. Yeah. So in services to an employee, therefore you are going to be snapped by IR35. So that is a great clarification point. Yeah, I think you are more protected provided that you have other employees. Peter saying thank you. You're very welcome.
Pleasure.
So back to this deed of assignment. Take it away.
Okay, so deed of assignment, deed of trust, they're called all sorts of things. We did a live streaming event on the 17th.
Oh, don't guess.
Something like that.
Don't guess.
Something of August. I forget now.
You're digging the hole. Come on. We haven't got long.
We did a session and we covered deeds of assignment. So I would highly recommend. Is it already on the?
It's on YouTube Live, so do feel free to go through that. And if you put a deed of trust,
20 minutes on it.
Yeah, do go onto that. We talked about deed of trust, and we have done several videos on this subject. So please do look at that. It's an
awesome tool in your toolbox.
It's so detailed that it can take 20 minutes, and that's why we want to try and keep this tax returns as much as we can possible. Yes. I would say. So let's move on to the other questions. Let's see if they are much more tax focused. Thank you for elaborating on this point. What happened if the property is making £300 per profit? Is it worth doing a self-assessment? Yeah, per year. Is it worth doing a self-assessment tax return? Well, just hold your thoughts because I know you're at the starter's gate, and I'm just trying to hold you back. So there was a question, and I'm going to pin this question to this, what's just been said. Where was it? There we go. So it talked about, I'm sure it was on here, where we talked about the allowance. Okay, so what is the property income allowance? What is the £1,000? This is where we talked about doing
Trading
a bit of research on it.
versus property allowance.
So do you need to do a self-assessment tax return, Louise, if you've got property, as this person's just said, whereby the property profits in a year might be less than £1,000?
The long and short answer of that is no, you don't need to do a personal tax return. You can earn up to £1,000 of income, not profit, £1,000 of rental income a year, and that would be that would not require you to complete a personal tax return, and everybody can benefit from the first £1,000 worth of property income tax-free, so long as there are no expenses set against it. So if you're in a position where you've got £10,000 worth of property income, but £5,000 worth of costs, then I'm afraid you can't have that £1,000 tax-free. You would be better off to set the £5,000 of expense off against rather than the £1,000 of expense against the income.
Can I just clarify, because this is new to me, because I don't do tax returns, I've been told not to, for good reason. So if you've got £1,000 worth of, let's say £1,200 worth of rental income, £200 worth of cost, and therefore it gives you £1,000 or just under £1,000, does that mean you have to do a tax return just because you got £200 worth of costs?
No.
Right.
No. So the question you need to ask yourself, in fact, there's two questions you need to ask yourself to work out whether you need to do a tax return in the year to do with property income. Let's imagine for a second there is no other reason that you need to fill in a self-assessment tax return other than to do with property. Okay, and there's lots of other reasons why you might, but let's imagine you've explored all those and there's no reason to do so. You've got to answer the following two questions, and if either one of them results in a yes, I'm afraid you're going to have to file a tax return. The first question is, have you made more than £10,000 worth of rental income in the year? So put aside all the expenses and all the costs of running your property business. Has the rent that's come through the door in the tax year in question equaled more than £10,000? If the answer to that is yes, you have to file a tax return, even if your expenses were £11,000 and you've made a loss. Because your total gross rental income coming through the door is more than £10,000, you're now forced into doing self-assessment tax returns. Let's imagine for a second that your gross rental income was less than £10,000, so you answered no. So actually you don't need to file a tax return at this point. The second question you then ask is, okay, now if I set against that income all of the allowable expenses that I can, do I result in a profit of more than £2,500? If the answer to that is yes, then you have to file a tax return. If the answer to that is no, and you answered no to, actually, I haven't got £10,000 worth of rent coming through the door, it's less than that, then you don't need to file a tax return. You do need to keep a record, obviously, of all of the incomes and all of the expenses, because if you are making a loss, you can use that loss to set against future profits. And I'm not going to jump into lots of detail on that point on this session, because I think I'm going to blow all of your minds because we're covering so much stuff. But in order to work out whether you need to file a tax return for the year because of your property, just keep your brain around, have I earned more than £10,000 of rental income, and have I made more than £2,500 worth of profit?
Can I just ask a quick question on that point? Because the property income allowance is £1,000.
Yes.
And it says you can earn that tax-free and there's nothing to do. But that almost contradicts what you've just said in regards to £2,500. I appreciate it's coming from Hmrc, so that's totally feasible that Hmrc would write something and then contradict it with something else. But if you've got, let's say you got 2,000, so you got 9,000 rental income, so that would almost negate the 10,000 rule, and you got £9,000 worth of cost, there's all these £2,000 worth of profit. Would that suggest you wouldn't need to do a tax return?
Is so long as you answer no to both of my questions,
yeah,
you don't have to file a tax return.
Okay.
What you will need to do, of course, if you have made rental profits, but they're less than the £2,500, is you will need to speak to HMRC to work out how you're going to pay the tax associated with it. So I'm afraid it isn't a get out of jail card. It doesn't mean you don't have to pay any tax to do with your rental income. Let's imagine you have made just under £2,000 worth of rental profit when you net away the expenses from the income. You're going to need to speak to HMRC to work out how they're going to tax you on it. More often than not, many of my clients at that point kind of go, oh, well, I'm going to make more money next year. I'll just get on the bandwagon. I'll get on with my self-assessment. And that's entirely up to them. And to be honest, I would recommend that, because that way you are capturing all your income, capturing all your expenses. It's in the nicest of ways forcing you to make sure you've got a good quality set of records of what you've actually incurred as incomes and expenses. And you never know, your mortgage broker might need it as well if you're looking to grow your portfolio and they want to see the incomes too. So my view would be... Just
on that point, Louise, because I want to focus on property income for a second, and this question that we're trying to focus on. It says here, so everyone, I've put a link in the chat box so you can have a look at this. And I want for us to all bear in mind what Louisa said with the property income of £1,000 as well. So it says here quite clearly, property income personally owned. The first £1,000 of your income from rental income is tax-free. This is your property allowance. Okay, so that pretty much says 1,000. Now, my question was 2,000. What happens? Because it's below the 10 and the 2. It says here, you must report it on a self-assessment. So contact HMRC if your income from property is between 1,000 and 2,500 a year, right? So that marries up with what Louise was saying. You have to then contact them. It's bonkers, because I think you should just be doing a tax return. If you're making £1,000 worth of income, all they're going to say to you, quite frankly, is, yeah, I think you should do a tax return, because these guys aren't qualified.
Well, they're going to ask you how much income you've made. They're going to record that down, and then someone else is probably going to contact you and go, we think you should do a tax return.
Yeah, I personally think that if you've got any kind of rental profit at all, declare it. I think because most, correct me if I'm wrong, but if you have £1,000 worth of self-employment income or property income profits, tax calculation systems now would deduct that anyway, wouldn't they?
You have to. Most software worth its salt will require human intervention to make that work. And certainly the software we use, it's very sophisticated, but it knows there might be reasons why not to include that allowance.
Okay.
So you have to force the issue.
Yeah.
It's a little complicated.
I mean, that's why I talk from a tax perspective and you talk from a self-assessment tax return, because you know the practicalities of this. I only knew the theory, which can be frustration from your side. But from my side of saying I did see that, by the way. But if you have got the confusion could be, I've got more than £1,000, which is my property allowance. I've been told to contact HMRC and I can't get through. And that's just going to end up in tears of frustration, because they'll say the same thing I'm just going to say to you is, just do a tax return. If you've got losses, you can carry them forward. What are you losing? If you've got that £1,000 and it's just £1,000, then maybe speak to an advisor, because it could be worth you speak to pay an account just to tax return and save yourself that tax itself. Let's be fair though, if you're a basic rate taxpayer, you're on £1,000 worth of profits, £1,000 property profits, £200 tax. You probably pay more than that for the accountant just to get you that answer, I would have thought.
But sometimes it's more about the certainty of knowing you're doing the right thing.
Yep.
The frequency with which I have to assist people because they haven't done the right thing, not because they went out of their way not to do the right thing, but because they didn't ask the questions they should have. They didn't join sessions like this when they could have. We end up having to sort out quite a mess. And we'll always help, we'll always do whatever we can. But actually, it must have caused that client years, months, hours of grief and worry and concern that they hadn't done things right and panic.
Let's not do counselling. Okay,
let's
move on.
My view would be, if you're not sure, go talk to your accountant.
Yeah, absolutely, for sure. Let's talk about an opportunity here. So,
I like opportunities.
Yeah, opportunities whereby you've got income, you can generate an income from property. And people think about, well, it's costly because I've got to get a buy-to-let mortgage, I've got to put a deposit down, and they completely forget that they could easily just rent a room of their own property. Now, if you was in a particular place whereby you've got 5 bedrooms and your children have left, whew. But then you have 1-2 rooms spare, you could easily rent out, let's just keep it things simple, but you rent one of those rooms, you could charge rent from your property and earn how much tax-free income?
So it's called the Rent a Room Scheme, help sheet 223, if you want to go and check it out on HMRC's website. And you could rent out your rooms and make £7,500, pounds, not quid, pounds.
Thank you, Louise.
Tax year, and pay no tax. Not even register it through HMRC's self-assessment if that would be the only reason you would be doing it. Now, the £7,500 needs to be all of the income that you're earning. So it could be a mixture, for example, of both the rent for the room. It could be expenses towards food or meals that you might cook for them. It could be, for example, for cleaning, laundry services, all of those things. That's what the £7,500 is to cover. If you own your home jointly, then you can each claim half of that. So in effect, you can still, as a family living in one house, renting out one room to a lodger, you can still earn up to £7,500 a year. The important thing is that the room has to be furnished and the individual has to be there that house with you.
So it can't be a separate annex or anything like that. It's in a part. The other side to that is if it's 7,500, there is, I believe, there's 2 options to prepare your tax return. There is the element of, well, if it's 7,500, just use the rental room allowance. Is there a possibility of saying, well, this is my property income and this is my proportionment of expenses against that?
Absolutely. And the lovely thing that HMRC allow you to do is to look at either how much did I earn gross rent, so £7,500, versus how much did I earn gross rent less any expenses I incurred. So that if, for example, your gross income was £10,000, if you follow the rent a room relief, it means only the first £7,500 is tax free. So in other words, you're going to have to declare the other £2,500 in your tax return and have it taxed. Let's imagine on that £10,000 worth of income, it actually cost you £9,000 to actually deliver the room, which would be quite frightening, but that could happen. So if you were to work out the genuine profit on that room, then it would actually only be £1,000, wouldn't it? Be 10,000 minus the £9,000 expense. You can choose to apply the real expense, the 9,000, and therefore declare a £1,000 profit. Or you can choose to use the rent a room relief of 7,500. You just can't have the two. So you either declare your expenses or you use the £7,500 rent a room relief. And HMRC let you toggle between the two every tax year, depending upon which one gives you the best result.
Yeah, I think it is good to try and marry the two up, because in the rental room allowance, let's imagine that you charge £10,000 worth of gross income, rental income, yet 7,500 rental room allowance, leaving you 2,500 as income, and that would be taxed. But if you have £10,000 and £8,000 worth of costs, you've got 4,000. You kind of got to weigh it up. But if it was £10,000 worth of costs and £10,000 worth of rental income and £8,000 worth of costs, that's £2,000 profit versus the thing. And that might happen if you're in London. So if you've got an expensive apartment, for instance, and you're renting one of the rooms out in a 2-bedroom apartment suite, actually you could be in that position whereby your rental income isn't going to be necessarily huge amounts of profits, but it could be way above more than the rental room allowance of 7,500, as for example, depending on the margins.
And it's the lovely thing that HMRC currently, and have always, as long as this relief has been in place, allow you to toggle between the two every year and allow you to use the one that gives you the lowest profit and therefore lowest tax.
There's plenty of questions coming in, so I'm going to save the ones that, but I do need to get to the questions that people have been asking before the people have registered. So Andrew Crampton, so good evening, Andrew, if you're listening in. Andrew has asked a question. I can spend some time doing listings, interviewing, showing tenants around properties. I might even be doing some repairs as well. I know I can offset the actual repairs for the cost of the work being done and labour if I choose to use it. But I feel rather frustrated that my time isn't being allocated anywhere. And that's a genuine concern, because you're putting time and effort into your property. You're doing some more work. You kind of thinking, but I'm not getting any relief from this. But you are in many ways, aren't you, Louise, if you want to take it from a tax return perspective?
Yeah, so I completely get where you're coming from, Andrew. You know, you're putting all the hard work in, yet you're not allowed to expense your time as a cost of labour to the business. Ultimately, HMRC see your time put into the business as saving you the need to hire in additional labour, whether that be a maintenance person or a letting agent type person, which allows and affords you to earn more profit, which is actually therefore more money in your pocket than there would have been had you had a labourer or third party provide that service for you. And ultimately, yes, it does mean more tax as well. But HMRC don't see it that way. They see it from the angle of, well, you've made more profit because you've done the work yourself, and therefore you've generated and benefited from it. So sadly, that's the way HMRC see it.
So I'm just trying to get something to copy and paste. It's not working, so I'll have to do that in a sec. Yes, I will come back to that. The other ones I want to go through was DA Test KA.
Hello.
So yes, good evening. How do you deal with interest paid on property with 3 shops at the bottom and 3 flats at the top? So we're talking about a mixed use property, aren't we? So again,
lovely question.
Just out of interest, where is when we just hold that paper up, yeah, hold that for me, because we need to reference this. We need to get into good habits here. We need it on the back chart somewhere. They can't see it though.
No, I know. I'm just trying to work out where my finger's going to go for it. Okay. Right.
So where would property income come from? Commercial or residential? Does it go on the same page?
So typically, whether it be rental of residential units or rental of office units or rental of garages, doesn't really matter. It will all still go in the rental box, which I think is the one I'm pointing to. So box 20 up here, rental income.
Okay.
Hopefully you can see that. So that's all going to go in there.
Because the big question that comes out of this, and anyone listening in understanding section 24, means that you cannot offset residential mortgage interest against your tax return. In fact, there's a couple of boxes here. Is it shown in this one to say allowed and disallowed?
Not really, no. So this tax year, 2021, which is what this tax return is the first year in which no residential finance costs are allowed. So what you have instead, I don't know if you can see where my little finger is here. So box 26 is your non-residential finance costs. So if you were, for example, renting out exclusively properties, or rather buildings that were non-residential, offices, warehousing, garages, then you would capture any finance costs associated with running them here. That's where you capture that, because that is still a taxable expense for your business, which is a real kicker in the teeth, but it is just the way it is. If, however, you only rent out residential property and you have mortgages and therefore pay mortgage interest, I'm afraid you are relegated, for want of a better phrase, to load in your finance costs down here at box 44, this one second from the bottom on the right hand side. And there is, in my brain, quite psychologically, a good reason it's down at the bottom, because it's considered at the bottom of the pile for saving your tax. Because now it is not treated in the same way in terms of assessing what your profit is, which is then what is assessed for tax calculation purposes. If you have, like DA Test KA, I think it was, a situation where you have a single building and some of it is residential and some of it is non-residential, then you have the opportunity to capture some of your mortgage interest, assuming you have it mortgage interest, DAK test, here for the non-residential portion, and here for the residential portion. So you're in a place where you can arguably assign some of your finance costs to a tax deductible line, which most people cannot. How do you decide how much to load? If it's in a single building and you've got a single mortgage on it, then you could look at apportioning some of those expenses across both the residential and non-residential parts. So there's 2 ways that I would typically look at this for a client. The first way is I'd look at the floor apportionment. So I'd look at how much of the floor area is non-residential compared to residential, and I would use that to inform me how to split across those 2 finance cost boxes. The second methodology is to look at how much rent those 2 different types of units give me, and then use that as the method to apportion how much I load in the expense. And quite frankly, I would use the apportionment version that allows me to load more of my expense in this lovely top box up here, where I can use the finance cost to minimize my profit, and as little as humanly possible down here. I would, of course, use the apportionment method very carefully and rigorously so that if HMRC did inquire, I have good logical data to explain how I'd come to the conclusion, as opposed to, well, finger in the air, I thought it was about 25%. That would be my suggestion.
I'm just reading some questions because I've just realised the time is already 8:54 p.m.
Blimey.
6 minutes, not long. So we're going to blast through these questions.
Blast. Go for it.
Max Chung. Good evening,
Hello,
Max. Max has asked the questions. How do I categorize these costs? I engaged a sourcing agent for my purchasing and buy-to-let under my name. I've got a sourcing fee and other fees like surveys, legals. For me, I'm just going to be very quick with these questions because I know we're going too much time, but I would say these are capital in nature.
Yeah, go back to PIM 2030 and PIM 2068. I would suggest, Max, have a good nosy at the data. Things typically like sourcing fees, surveyor costs, professional advisors helping you buy the property, I'm afraid, are capital. They're never going to be captured on this part of the tax return. They're only ever going to be captured on the capital gains tax partial return should you ever sell the property.
And that would be, I would argue, alongside the mortgage arrangement fees on the initial purchase as well.
Yes.
But Max has asked another question,
Oh,
so
okay.
I'm going to
Brilliant.
fire a couple of these out. It's how do I categorize and evidence these costs? And I think we talked about it already in terms of invoices backed up with bank accounts and so on. So do check back, Max, of what we've already said.
Completion statements as well, where purchase and sale that your solicitor will provide you with, are amazing sources of liquid gold information, particularly for capital items, not necessary revenue, but do not lose them. You get a completion statement on purchase, you get a completion statement on sale. They'll list out a whole load of expenses and items that we can use and that HMRC will happily utilise to validate certain pieces of information as well.
Yeah, I know we're getting into it, and I think if we just run over by 5 minutes, I'm cool with that. What I would ask you to do is just like this video. If you're finding it's very interesting, please do give it a like, whether you're on LinkedIn, Facebook, YouTube, this Clubhouse that no one's in, but all of those channels, if you can give it a like, that would really help. And subscribe. So if you're not on YouTube yet, please come join us on YouTube, because we have got a session next week anyway, talking about business and property tax, and that's more theoretical tax. Tonight is all focused on self-assessment tax returns, as you can probably appreciate. Yes. I'm going to leave that deed of trust one. We already talked about that one, and capital gains tax. Now there's some questions live, so I want to. Oh, Max did ask a question. I want to go through this one. Does my UK rental income need to be reported in Hong Kong? I can tell you categorically that the Inland Revenue Department in Hong Kong does not ask you for foreign income streams. They only focus very much on Hong Kong, which is taxed at the maximum. Get this, people, for anyone listening into the UK, get this. Hong Kong is a maximum tax charge of 17%. Did someone just say that they moved to Hong Kong?
So unfair.
You know, so, but you...
amazing, Max.
Amazing
enjoy
that
it,
you can have that.
it.
But you don't have to report any income from the UK into Hong Kong at all. You just have to report the tax in the UK. So you do make profits, you will be taxed in the UK. So you do need to bear that in mind if you've got UK property, Max. Going back to the live sessions, because there are questions on there.
Awesome.
And there's some good question actually. Sunil, I saw, but I want to make sure I've just answered most of these. Yes, I have. So that's good. Sunil has asked a question.
Hey, Sunil.
My wife has sold shares in pharmacy as a share deal. How does she apply entrepreneurial relief? And is this a final tax after expenses 10%? That's an interesting one, because entrepreneur's relief really is, let's just go through some of the rules and regulations together, but you have to be more than a 5% shareholder in a business. Is that right?
So yes, and it's now called business asset disposal relief, or my favorite phrase, badder, because it really is badder than entrepreneur's relief. Sorry, that's my very poor joke there. My 7-year-old son would be very unimpressed with my grammar there, I have to be honest. Entrepreneur's relief, badder, call it whatever you want to call it. You've got a number of hoops to jump through. One of which is you've got to have owned shares in the company for 2 years. You've got to have been an employee in a certain number of years since you own the shares. You've got to have approximately 5% or more of the voting stock in the business. And there are a couple of other things, and my brain's gone dead as to what they are, but I'm sure they'll come back.
No,
But if those are the key things, so long as you meet those criteria, in the year in which you sell the shares, as in the tax year in which it falls, and don't forget tax years are from the 6th of April, year 1, to the 5th of April, year 2, depending upon which year the share sale occurred, is the year in which you capture it in your personal tax return. And you need to ask the accountant to capture it under entrepreneur's relief, which will basically mean that any capital gain exposed to tax is ring fenced at the 10% capital gains tax rate. So normally when you sell shares, you're charged either 10% or 20%. If you sell a residential property, it's at 18 or 28%. For the sale of shares in such a pharmacy business, if it does indeed meet the BADA criteria, then it will be at just 10%. And don't forget, the first 12,500 pounds for 2120, is it 12,300?
12,300.
Is it still 12,300? So the first 12,300 of capital gains made in any tax year is completely free of tax. Yay!
Yeah, I think in terms of, but I think you do need to get some advice on that, because if you talk about shares of a pharmacy, is that indeed your own pharmacy, or is that just Lloyd's pharmacy as an example?
I'm guessing the way you've written it, it is a pharmacy business in which she was working and owned shares in, but to Simon's point, get it checked.
Always. So this is My Bell, a Spicy Family.
Oh,
now I'm sure, I wonder if it's My Bella Spicy Family. In fact, I think it is. If it is that, it's probably going to be an Italian restaurant, I would have thought. If you started renting in January 2021, so this year, each and £1,200 each month, do I need to file a tax return? I assume I don't need to file a tax return this fiscal year, but next year I need to file. Is that right? So let's think about this. So the tax year in the UK starts from the 6th of April and runs to the following 5th of April. And in this example, My Bella Spicy Family, I hope I got that right, is therefore got income in January, February and March of 1,200 each month, right?
Well, hang on a second.
Okay.
So it depends exactly when the rent lands and when it is due payable. Okay, so there's a couple of different ways you approach this. There's accrued and there is cash basis. I'm going to work on the accrued basis. I've probably just sent all of you over the edge. What I mean by that is, when is something payable, whether the person pays it or not. So if you had rent coming in on the 1st of Jan, the 1st of Feb, the 1st of March, the 1st of April, all 4 of those fall in the tax year that ends on midnight, the 5th of April. If, however, you have income landing in January, February, March, but then the April payment doesn't land until after the 5th of April, then you have just 3 payments. 3 payments at 3,600, back to my example of calculations. Is that more than £10,000 worth of income? No. Is there more than £2,500 worth of profit? Don't know. Don't know what your expenses are to having earned that 3,600. If the expenses result in it being a profit of greater than £2,500, then you will need to file a tax return for the 2021 tax year, and your deadline for filing, if you do electronically, is the 31st of Jan 2022.
I'm going, yes, I think you have, but I think, because this will make a good video, so that's why I'm pausing. But what I'm thinking here is accruals versus cash basis. Okay, so this is where tax returns can be done, right? It can be done on a cash or accruals basis. My understanding is that Hmrc expects you now to do your tax return based on a cash basis.
Yes.
Unless you tell them otherwise. So they naturally assume that you are now doing it on a cash basis. What does that mean? Well, you only account for it when it's hit your bank accounts from a rental income. So it's gone into your bank, and the expenses have left your bank accounts for you to account for the costs. So you need to really use your bank account to tell you your income and expenses from a cash accounting perspective, because that must go onto your tax return. With me?
Yes.
But?
And. Not a but, an and.
Well, let me continue then.
Go on.
But if you use accruals method, then that's slightly differently. That doesn't really take into account what cash has landed, but what rental income would have been generated. as for example, what Louise talked about, the £1,200 in your tax return, 1,200 in January, 1,200 in February, 1,200 in March, 1,200 in April. If you did the invoice on the 1st of April, even though you haven't received that income, you would still account for it under the accruals basis. So it's kind of something of you've issued the invoice but have not been paid, you still account for it on the accruals basis. So what's best, accruals or cash? And I would always say, from a rental perspective, always try and do it on cash unless you've got significant outlay, such as repairs and renewals. But to make things easier, I would say, do everything on a cash basis, because you can reconcile it to the bank accounts, you can put it through your bank feeds, and you know where your invoice is going to go through. Unless Louise is going to poo-poo.
Well, I'm going to poo-poo that.
Oh, there we go.
So my view would always be do it on an accruals basis, because the moment you switch off accruals is the moment you kiss goodbye to certain tax reliefs. Not all of the tax reliefs will apply to you today or tomorrow, but they might apply to you in the future. And if you start doing things on a cash basis, it's really hard to unravel and then turn to accruals. So my view is, for our clients, I much prefer them to do accruals because it leaves the door beautifully open to certain tax reliefs. Now, one that jumps out immediately into my brain is if you're doing things on an accruals basis, you can actually claim certain things such as capital allowances. Now, they can be really hard to get for residential property businesses, but they're not impossible, and they are still certainly available for some things. So I wouldn't want my clients closing that door unless they have a very strong reason to do so. So for me, I much prefer clients doing what's called traditional basis, which is accruals. And in fact, you'll see, I think it's on, let me see if I can find it. So back onto this tax return up here, it says, how are you doing your return? Tick this box if you're doing traditional. Traditional is their nasty word for accruals. That box for most of my clients is ticked.
Okay, you heard it here first. So I would have thought that the cash basis is the better of choice. I will sit here corrected and take my hat off.
You heard it.
Yes, there we go. We are coming to a close. We're 6 minutes past 9. I am going to finish off on one. Yes, sorry. I know some people are asking some questions. Come back next month. We have got a property business tax Q&A next week. So yes, join us next week for that.
Sorry.
But it's not based on tax returns. It's just more theoretical stuff. Yes. But there is one question I do want to answer because it's related to things that we've spoken about recently, and it's relating to tax returns. And Afzal has asked the questions. Afzal Khan, thank you ever so much for your second question. How is the income from stocks and on cryptocurrencies taxed in the UK? I'm just going to focus on stocks is easy because that's really capital gains tax. Typically, you'll have a trade of shares, and there is now case studies on that to say it should be. Cryptocurrencies is the more trickier one. So to answer your question, shares is definitely going to be one of those capital gains tax. Where you're doing cryptocurrency, you're doing repeated trade, there's been the heavy debate on how should you account for it. We, as in Louise and I, and the tax team behind us, have had this debate going on for weeks on end.
Raging.
It has been quite intense on some of the kind of, well, this is what I think, this is what and we need to always base it on evidence. We've spent so much time on this now, and I can conclusively say that it's hard for HMRC to say that it's ever going to be income tax. And the reason for that, there's several case law whereby HMRC have attacked the notion of someone doing repeated transactions. So they try and tack it on the badge of trade. So you're doing frequent transactions. So you're not holding a stock for a year or more. You're doing 3 or more transactions a month. And therefore, what HMRC was trying to say, it's trade. The courts have said, no, it's not, because you're just looking after your investments. The fact that you do multiple trades, you might have to do multiple trades in your investment portfolio because they might not be performing. What you meant to do, just let them go downhill just because of tax. And I think the courts have got that right, that HMRC have just lost their heads and again, just try to attack it without thinking, well, from a commercial perspective, you wouldn't keep some shares just because of tax. So you would get rid of them. The other side to it was based on experience. So if you're doing things because you're quite knowledgeable, you've been on courses, you've gone to seminars, you're using a platform, which is an interesting one, using a platform to do your share dealing and so on, then HMRC have attacked that as well to say, well, actually, we think that's trade because you're using commercial software, you've got an expertise in this field, therefore surely it's a trade. The courts again overturn that decision to say, well, we don't care that they're using that piece of software. The fact is, most people that are doing a bit more investment activity would use a platform because it makes it life easier. So it's nothing to do with a trade, it's just making life easier. So again, your head's gone, HMRC, think again. The only time that I can see a court case that's ever gone through where HMRC have really legitimately won is whereby someone's acted on someone else's behalf. So Louise gives me her money, so I'm using a regulated platform. I'm doing some sharing, not just for myself, but I'm doing sharing for other people. I'm now providing professional services. So unless you've really ticked on all three boxes of kind of the number of transactions you've done, the platform you're using, and you're providing some sort of service, not just for your own activity, then HMRC are struggling. And it's in case law now, so I don't think they're ever going to win now. That it's never really a badge of trade, and therefore it's income tax. It's always good to be capital gains tax.
And this is on cryptocurrency.
It's on cryptocurrency, but they're saying this on shares as well, because cryptocurrency is a form of transaction, and we have to take a holistic viewpoint. And that's where I come in, because I'm much more tax theoretical than I am just a tax return person. But it is looking at, well, what are you trying to do in theory as well as in practice to say, well, do you lend yourself to one thing or another? So have you got any thoughts on that in terms of our conversations that we've had with the tax team?
I don't think so. I think there is a real misunderstanding of cryptocurrency in general, I would say, and people getting it wrong as to what constitutes a transaction that needs to be recorded for tax return purposes. And I would say, ultimately, it really is down, sadly, to the self-employed or individual creating a self-assessment tax return. You really need to go do your research, not just in terms of, spending tens of thousands of pounds in cryptocurrency. You need to go do your research on when you will be classified as having triggered either a gain of some kind that is taxable, and how you record that and how you value that gain. So go do your research. You really need to be clear on that before you start.
The one thing I would say as well, one of the court cases I saw was moderating how much income you made. So in one particular case, and I would put this into and I will be pushing this into an article because it's so big into the content. But one thing they said was, well, let's have a look at your income streams. So in particular, one person had £200,000 worth of employment income, and £20,000 worth of investment income. And again, HMRC said, well, that's clearly trade. But the court said, well, it's not, because, again, look at the proportionment. If it was a trade, it would be more than what he's been earning from employment. He's clearly an employee, just putting that investment income into good use. So again, it's about using commercial sense. So hopefully that's giving you some idea about cryptocurrency and how it's being triggered against HMRC. There is this whole thing about badge of trade. I just think it's HMRC are going to totally struggle with the badge of trade with cryptocurrency, even though it's very active. It still goes back to the principles of investing. You can't be really much of a badge of trade unless you tick so many boxes. Yes. In all honesty, but you do need to get expertise to get that confidence, if I would say. But on the whole, I would say I'm happy with that. Before we close, because it's 9:15, Dr. Sunil has said, thank you for helping me with my wife's pharmacy shares. She was the director and 50% shareholder. So she's going to get this entrepreneur's relief. There's no issues with that.
All the way home. Happy days.
You are limited. It's £1 million, isn't it?
Yeah. So in other words, if you sell shares and make a capital gain of £1 million, then all of that can be captured at the 10% rate. Don't forget, you get the annual exempt allowance of 12,300. If, for example, those shares were sold and someone made £2 million, then it's only the first million that we captured at 10%. The remaining 1 million would be at the 20% rate, just so that you kind of got a flavour of how that would work.
Yeah.
But fantastic. Well done her for all the hard work she's clearly put in over the years, and hopefully she's now benefiting.
And you can get to enjoy it.
She will get to enjoy it first. Thank you very much.
So now, have a nice party. Thank you ever so much for joining in tonight. Hopefully you guys have found this useful. We are going to do this as a live session, especially as we come to the end of January, where people kind of trying to get their tax returns nice and early. But if you are here next week, we will be talking about business and investment tax, and not just property, but investments, such as someone's question about business related. So if you've got questions in theory that you want to talk us through, proactive tax planning, as well as kind of my tax returns, then come join us next week, next Monday at 8 p.m. Go to our website, which is www. In fact, what I will do, just keep you online for a second. Any final thoughts while I try and stall?
Yeah, so what I wanted to say was my aim for tonight was to start taking away the myths and the worries of starting to look at self-assessment tax returns if you know you've got to do them, or take away the worries of, do I need to look at a self-assessment tax return? And I genuinely hope it's helped tonight. It's a big journey, and I know it's a long journey, and tonight is only the part of it, but I'm hopeful that actually we have started to help you guys. And if it has been of genuine assistance, please do click the like button and subscribe, because we'd love to have you on board with this.
And I'm just putting in a link to future live events as well. I have noticed that it didn't work, so I will put that in there. But if you are around next week, I don't know what's going on with my laptop. I think I do need this new laptop. But join us next week if you want to talk about proactive tax advice. If you want to talk about tax returns, join us next month, whereby, again, Louise will be taking the floor to answer your questions. So thank you ever so much, Louise, for this wonderful session.
Pleasure. Thanks so much, everyone. See you soon.